Hi, this is the Business Guy. So how do you get a mortgage? The definition of mortgage is a type of loan used to purchase or maintain a home, land, or other types of real estate. In order to get the best deal you can, it's a good idea to learn as much as you can about getting a mortgage before you start shopping for a home, buying another home, buying an investment property, or refinancing. In fact, I personally purchased over 50 properties. I owned and ran a bank that did mortgages, and I was also in the mortgage note buying and selling business as an investor. Watch our video on how I started a bank. So the best way to avoid wasting time is to learn from someone with experience and learn the mortgage process. And even if this is your 10th mortgage, if you watch this video all the way through, I'll bet you'll learn something that'll help you get a better deal on your next mortgage. So in this video, we'll get you ready to go mortgage shopping by going over what we as lenders look for, the paperwork involved, and the 5 steps it takes to complete the mortgage process. Then in part 2 of this 2-part series, we interviewed my friend Bob Zielinski, Vice President of U.S. Mortgage, and he's been in the mortgage industry for over 3 decades and is the best source of information I know on getting the best mortgage for you. And he also gives some incredible tips on how to get a mortgage even if you've been turned down elsewhere. So I really encourage you to watch this video as soon as you finish watching this one. So what are mortgage lenders looking for? The bottom line is that you can pay it back. And the bottom line for me is that you click the like button below so YouTube promotes this video. Many thanks. And you can also click the subscribe button and notification bell if you haven't already, so that when more videos come out like this one, you'll be up to date right away. So lenders look at a few different factors when you apply for a mortgage with a goal of assessing your ability to pay back the loan. Now the key areas taken into consideration are your income and job history, credit score, debt-to-income ratio and assets, and the type of property you're looking to purchase. Income and job history. One of the first things that mortgage lenders consider when you apply for a loan is your income. There's no set dollar amount that you need to earn each year to be able to buy a home. However, your mortgage lender does need to know that you have a steady cash flow to pay back your loan. So your lender will want to look at your employment history, your monthly household income, or any other forms of money you have coming in, like child support or alimony payments. Credit score. Your credit score plays a major role in your ability to get a mortgage. Now, standard lenders such as Rocket Mortgage or U.S. Mortgage will need to see your credit history. A high credit score tells lenders that you make your payments on time and that you don't have a history of borrowing too much money. A low credit score makes you a riskier borrower because it tells lenders that you may have a history of mismanaging your money. The minimum credit score for a conventional loan is usually 620. For a government-backed loan, you'll need a credit score of at least 580, but that can vary depending on which loan you choose. A higher credit score can give you access to more lender options and lower interest rates. Now, if you have a lower score, it's a good idea to boost your credit score for a few months before you apply for a loan. Plus, there are lenders such as Churchill Mortgage. If you're totally debt-free and you don't have a credit score, they have a manual underwriting process that looks at the property and your income. Debt-to-income ratio, DTI. Similar to income and credit score, your debt-to-income ratio is a strong indicator used by lenders to determine if you have the requisite cash flow to qualify for a mortgage. Now, your DTI is calculated by taking the total of all of your minimum monthly debt payments and dividing it by your gross monthly income. The types of debts that you'll need to factor into your DTI will be the recurring ones, such as your credit card payments, student loans, and auto loans. Expenses like groceries or Netflix subscriptions can be left off when calculating DTI. Now, depending on the mortgage type you're applying for, the DTI a lender is looking for will vary. Typically, for a conventional mortgage, a DTI of 50% or less is the benchmark, but many government-backed loans will have higher thresholds. Assets. Lenders will want to know that you have some extra money in the bank when you apply for a loan. And this assures the lender that you'll be able to make your payments if you run into financial trouble. Your lender will also ask to take a look at your assets, which include any type of account that you can draw cash from. Now, here are a few examples of assets: savings accounts, retirement accounts, and taxable investments. Property type. The type of property you buy affects the type of loan that you can get because different types of properties change the level of risk for your lender. Want to buy a small single-family home that you plan on using as your primary residence? You'll probably get better terms because lenders know that primary housing costs already factor into most people's budgets, and you're more likely to stay up to date on your payments. Investment properties, on the other hand, will take a back seat to the primary residence if the owner runs into financial hardship. To balance the potential risk, lenders will likely require a larger down payment and a higher credit score to qualify for an investment property mortgage. Now, interest rate and buyer requirements vary depending on the type of property that you're after. And keep in mind that not every lender finances every type of property: mobile, manufactured, commercial, etc. What documents do I need to get a mortgage? Get all of your paperwork in order, and you can speed up the process before you apply for a loan. Let's go over the documentation that you'll usually need when applying for a mortgage. Proof of income. Now, your lender will ask you to provide multiple pieces of paperwork to verify your income. And some documents might include the following: at least 2 years of federal tax returns, your 2 most recent W-2 pay stubs, 1099 forms, or profit and loss statements if you're self-employed, divorce decrees, child support decisions, and any other legal documentation that confirms that you'll continue to receive the payments for at least another 3 years. Legal documentation that proves you've been receiving alimony, child support, or other types of income for the last 6 months, if applicable. Credit documentation. Your lender will also ask you for verbal or written permission to view your credit report. They'll look at your credit history and search for negative factors like a bankruptcy or foreclosures, because those things would make it difficult for you to get a loan. Now, if you had extenuating circumstances that damaged your credit, it's a good idea to explain this to the lender and provide documented proof. For example, if you missed a few payments on your credit card bills due to a medical emergency, you may want to give your lender a copy of your medical bills. And this proves to your lender that the bad marks on your report were the result of a one-time instance rather than a recurring pattern. Proof of assets and liabilities. Your lender might ask you for some or all of the following when they verify your assets: up to 60 days worth of account statements that confirm assets in your checking account and savings account, your most recent statement from your retirement or investment account, documents from the sale of any assets you got rid of before you applied, such as a copy of the title transfer if you sold your car, proof and verification of any gift funds that were deposited into your account in the last 2 months, and your lender might also ask you for supplemental information on any debts you owe, like student loans or auto loans. Cooperating with your lender only makes the mortgage loan process easier, so be sure to provide any required information as soon as possible. Keep in mind, they're not being nosy, they're just trying to help you get your loan, and they need certain documents in order to do that. How to get a mortgage with a company such as Rocket Mortgage or U.S. Mortgage. Once you have all of your documentation in order, it's time to start searching for a loan. Now, here's what you can expect when you apply for a home loan. Step 1, apply for a mortgage pre-approval. Now, pre-approval is the process of learning how much a lender is willing to lend you. When you apply for a pre-approval, lenders take a look at your income, assets, and credit and tell you how much they can lend you. They'll also determine your interest rate. Although similar in name, a pre-approval shouldn't be confused with a pre-qualification. Pre-qualifications are less accurate than pre-approvals because they don't require asset verification. Where a pre-qualification can be helpful, it won't give you the most concrete idea of how much money you'll be lent, whereas a pre-approval can. And that's because lenders require you to provide documents for the pre-approval that can help prove income and debt obligations to ensure you're eligible for the mortgage. Getting pre-approved for a loan and knowing the amount of money that you'll receive will help you narrow your property search and make you more appealing to both sellers and real estate agents. Check your credit score. The first thing you'll do when you apply for pre-approval is to answer a series of questions about yourself, your income, your assets, and the home you want to buy. You'll then give your lender permission to look at your credit report. Now, your credit report is a record of borrowing history from any lenders and creditors you worked with in the past, including credit card companies, banks, credit unions, and more. Customize your personal mortgage solutions. After they verify your credit, the lender will give you a few mortgage options that you can customize to fit your needs. They'll typically show you a few different mortgage solutions, and how much you can qualify for. And you can also learn more about your individual interest rates, loan types that you may be eligible for, monthly payments, and down payment requirements. Now, from a saving you money standpoint, I strongly recommend a 15-year fixed mortgage. Some people think they can get a 30-year mortgage and they'll just pay a little more when they can. But a 15-year mortgage puts you on the right track to get your home paid off soon. Step 2, get your approval letter. Now, once you find the best mortgage solution for your needs, you can see if you're approved. And if you are, the lender can send you a pre-qualified approval letter that you can use to begin your house hunt. If you want even stronger approval, you may want to consider contacting a home loan expert and applying for a verified approval. Step 3, find a property and make an offer. Now comes the best part, finding the home that's right for you. To help you with your search, try connecting with a real estate agent in your area. And when you start viewing properties, especially if you're buying your first home, a real estate agent can help you narrow your search and show you properties that fit both your budget and your needs. And once you find the right home, your real estate agent will also help you submit an offer and potentially begin negotiating with the seller. And once the seller accepts your offer, it's time to move to the final stages of the home buying process. Step 4, verifying the details. During the qualification process, an underwriter takes a closer look at your assets and finances. You'll provide documentation and paperwork that backs up the information you submitted when you applied. And your lender will also need to verify your property details, and this usually involves ordering an appraisal, verifying the home's title, and scheduling any other state-required inspections. As soon as the underwriting finishes, you'll receive a document called a closing disclosure. Now, your closing disclosure tells you everything you need to know about your loan, including your monthly payment, down payment, interest rate, and closing costs. And make sure your closing disclosure is similar to your loan estimate, which you should have received from your lender 3 days before you apply for your loan. Step 5, closing. Once you get your loan approved, it's time to attend a closing meeting. Now, at closing, you'll have a chance to ask any last-minute questions you may have about your loan. Now, remember to bring your closing disclosure, a valid photo ID, your down payment, and a check for your closing costs. Once you sign on your loan, you're officially a homeowner. The bottom line, keys to getting a home loan. Lenders look for many factors when you apply for a mortgage. They'll examine your income, job history, credit score, debt-to-income ratio, assets, and the type of property you want to buy. You'll be responsible for providing them all the relevant documentation that can prove your viability to qualify for a loan. Now, the first step in getting a mortgage is to apply for a pre-approval. Getting pre-approved gives you a good idea of the loan principal that you can receive, making it easier for you to shop for a home within your budget. Once you're pre-approved, you can start viewing homes and potentially enlist the help of a real estate agent. Your agent can help you provide an offer on the right home once you find it. And you'll need to get full approval from your lender once the seller accepts your offer. Now, full approvals include underwriting and an appraisal. And once you're approved, you'll attend a closing meeting, sign any closing documents, and pay your down payment and closing costs. So that's how to get a mortgage, and if I remember, I'll put some links and contact info in the comment section. Thanks for watching. Please like, subscribe, and share this video. See you next time. This is The Business Guy.